Did you see the news this month? Probably not, because CNN didn't cover it. Saudi Arabia, the country that has exclusively used US dollars for oil sales since 1974, just made a deal with China. They're now selling oil for Chinese yuan, not dollars. Yuan. This is the beginning of the end for the petrodollar, and it's happening right in front of our eyes. But this is just one move in a much larger game, a plan China has been quietly executing for 15 years. Before I reveal the entire strategy, I'm curious, where are you all watching from? Drop your country in the comments below. And if you want to truly understand the massive shifts happening in the global financial system, make sure you hit that subscribe button. Okay, let me show you what's really going on. Back in 2015, China published a policy document called Made in China 2025. The Western media mostly ignored it, but buried deep in the economic section was a crystal clear goal: to internationalize the yuan, reduce their dependence on the US dollar, and create their own payment systems. Their target year was 2030. At the time, Western experts laughed it off. They said, China can't challenge the dollar. It's impossible. The whole world runs on dollars. But China wasn't asking for permission. They were announcing their timeline. And here we are, nearly a decade later, and they are way ahead of schedule. Their strategy is built on 5 pillars, and every single one is already operational. Pillar 1. Create an alternative to the SWIFT payment system. Pillar 2. Make the yuan a global currency for trade. Pillar 3. Stack up massive gold reserves to back their currency's credibility. Pillar 4. Break the petrodollar by becoming the world's biggest oil buyer. And Pillar 5. Export this new system globally through massive infrastructure projects. Let's break down each pillar with evidence, because this isn't some distant threat. This is happening right now. Just this past October, the BRICS summit was held in Kazan, Russia. And it wasn't just the original 5 countries anymore. This year, 32 countries were there as full members or partners. Egypt, Iran, the UAE, Ethiopia, Saudi Arabia. They announced something that should have been front-page news everywhere. A new international payment system they're calling BRICS Pay. This system completely bypasses SWIFT, the network that handles almost all international bank transfers and is effectively controlled by the United States. Remember what happened in 2022? The US and its allies froze $300 billion of Russia's central bank reserves and kicked their banks off SWIFT. Every finance minister in the world saw that and realized, if my country holds dollars, the US can freeze our money at any time. That was the moment China's alternative went from being an attractive idea to an absolute necessity. BRICS Pay lets member countries trade directly with each other in their own currencies. Yuan for rupee, riel for rand, rial for ruble. No dollars needed, no American middlemen, no risk of sanctions. China provided the core technology, which they've been developing since 2014 using advanced digital payment and blockchain systems. And countries are rushing to join. As of today, 159 countries. That's over 80% of the nations on Earth have expressed interest in joining BRICS or using its payment system. Why are they all joining? First, it's sanctions proofing. Everyone knows their dollar assets aren't really theirs anymore. Second, it's cheaper. Direct currency trades cut out most of the exchange fees and conversion costs. And third, it's about financial independence. Countries are tired of American control over their international business. China didn't force anyone. They just built a better, safer alternative, and now the world is choosing it. The dollar's monopoly on global payments is ending. Not overnight, but it's happening, systematically and deliberately. Let's talk about the yuan itself. 15 years ago, the Chinese yuan was barely used outside of China, but the numbers tell a fascinating story. Back in 2010, the yuan accounted for less than 1% of international payments, basically zero. By 2015, it had climbed to 2%, still tiny. By 2020, it hit 3%, starting to show up on the radar. But today, in 2024, it's over 5% of global transactions and growing every single quarter. This makes the yuan the 4th most used currency in the world for international payments. It's behind the dollar, the euro, and the British pound, but it has already surpassed the Japanese yen. Now 5% might not sound like a huge number, but look at the trajectory. It's doubling roughly every 5 years. If this trend continues, and there's no reason to think it won't, the yuan could represent 10% of international transactions by 2030, and maybe even 20% by 2035. At that point, it's a legitimate alternative to the dollar. So, how is China making this happen? One key tool is currency swap agreements. China has now signed these deals with over 40 central banks around the world, including countries like Argentina, Brazil, Russia, Saudi Arabia, and South Africa. These agreements are a game changer. They allow two countries to exchange their currencies directly with each other. Yuan for pesos, yuan for reals, yuan for reals. No need for US dollars as a middleman. This makes trade between those countries seamless. If Brazil wants to buy machinery from China, they can pay in their own currency or in yuan. When China buys soybeans from Brazil, it's the same deal. The dollar is completely cut out of the equation. This is a huge deal because China is now the largest trading partner for over 120 countries. That's more than the United States and more than the entire European Union. When you're the biggest customer, you have leverage. And China is starting to use that leverage, telling countries, "Want to sell to our massive market of 1.4 billion people? Great, we'll pay you in yuan." And countries are complying because they need access to China's market. Now here's where the strategy gets really interesting. Gold. China is accumulating enormous amounts of gold. According to their own central bank, their official reserves are around 2,200 tons, but almost no serious analyst believes that number. The real amount is likely much, much higher. Some estimates put it between 4,000 and 6,000 tons, maybe even more. Why the big secret? Because if China announced they were making massive gold purchases, the price would skyrocket instantly. So they buy it quietly through state-owned banks, through Hong Kong, and by keeping all of their domestic gold production, which is the highest in the world, within their borders. So why accumulate so much gold? Because gold gives it currency credibility. The US dollar hasn't been backed by gold since 1971. It is backed by the Freisanfreund, full faith and credit of the US government. But what if a major currency offered partial gold backing? This is likely China's long-term plan, not a full return to the gold standard, but a yuan partially backed by gold and other strategic commodities. It would be enough to give it tangible value and set it apart from other currencies. Imagine a currency that sends the message: this money is real. It's not just a paper promise. That's a powerful message, especially when other countries are worried about money printing and rising national debt. And it seems other central banks are getting the memo. They've been buying record amounts of gold for the past few years, preparing for a potential shift away from dollar dominance. Finally, we have the pillar that could change everything: the petrodollar. Since the 1970s, a deal between the US and Saudi Arabia made the dollar the exclusive currency for oil sales. Every country that needed oil needed dollars to buy it, creating constant demand for the US dollar and cementing its global dominance. China is now systematically dismantling this system. How? By becoming the world's largest oil importer. When you're the biggest customer, you can set the terms. And China's demand is simple: sell us oil in yuan. Russia was the first to agree, followed by Iran. Now, even Saudi Arabia, the kingpin of the petrodollar system, is negotiating yuan-based oil sales. The first yuan-denominated oil deals with the Saudis have already happened. It's just a test run for now, but the trend is clear. If even 30 to 40% of the global oil trade shifts away from the dollar, that's trillions of dollars in transaction demand that simply vanishes. And it won't stop with oil. Once oil trades in yuan, other commodities like iron ore, copper, and soybeans will follow. The links that have held the dollar system together for 50 years are starting to break. The world is changing, and the global financial system is changing with it. The rise of the yuan is a slow-moving but powerful force. The final pillar might be the most important for the long term: the Belt and Road Initiative, China's trillion-dollar global infrastructure project. Since 2013, China has invested over $1 trillion in infrastructure across 150 countries. We're talking ports, roads, railways, power plants, 5G networks, and digital infrastructure. Now, this isn't charity. This is strategic. Every port China builds, every railway they finance, every power plant they construct creates dependencies. And those dependencies translate into financial relationships. Countries that receive Belt and Road investments are increasingly trading with China in yuan. They borrow from Chinese banks in yuan. They integrate their payment systems with Chinese systems. Essentially, China is building the physical and digital infrastructure for a yuan-based trading system. Look at the port of Piraeus in Greece, now majority Chinese-owned and a key gateway to Europe for Chinese goods. Or the East African Railway connecting Kenya to Uganda, Chinese-built and financed, now seeing those countries trade significantly in yuan. Pakistan's Gwadar port is another example, a strategic naval and commercial base where trade is increasingly yuan-denominated. Southeast Asian nations connected by Chinese high-speed rail are also seeing yuan usage rise. This is economic integration on a massive scale. It's a combination of physical infrastructure, digital payments, currency usage, and trade relationships, all intertwined. And it's working. Countries along the Belt and Road are seeing 15 to 30% of their trade move to yuan settlement. China is patient. They think in decades, not election cycles. They're building the foundation for long-term currency dominance. While America debates and delays its own infrastructure spending, China is building the roads, ports, and digital networks that will carry yuan-based trade for the next century. So why is China's plan succeeding when so many people said it was impossible? There are four main reasons. First, the weaponization of American finance. The freezing of Russian assets was a turning point. Every country with dollar reserves now sees them as conditional, not secure. This created a huge demand for an alternative. Second, America's structural debt problems. The US national debt is $34 trillion. Deficits are $2 trillion per year. Interest payments exceed $1 trillion annually. The math is unsustainable, and other countries see this. They're diversifying away from the dollar as a risk management strategy. Third is economic gravity. China is the manufacturing center of the world and the largest trading nation. Trade naturally follows economic weight. As China's economy approaches the size of the US and their trade volume surpasses America's, currency usage is bound to follow. And fourth, patient execution. China announced their 2030 goal back in 2015. They've systematically executed each pillar over 9 years. They didn't rush. They didn't announce every step. They just built the infrastructure and let countries choose to join. And countries are choosing, not because they love China, but because the alternative system offers tangible benefits, lower costs, reduced sanctions risk, greater sovereignty, and access to the world's largest market. China didn't need to force anything. They just needed to build a credible alternative and wait for American mistakes to push countries toward it. If China succeeds in replacing the dollar, what does that mean for the average American? Several big consequences. First, inflation. The dollar's reserve status allows America to run massive deficits without immediate inflation because other countries absorb those dollars for trade. If that demand disappears, trillions of dollars flood back home, and that means serious inflation. Second, interest rates would rise. The US government borrows at low rates because of global demand for safe dollar assets. If that demand falls, interest rates go up, meaning more expensive mortgages, car loans, and credit cards. Third, a lower standard of living. The reserve currency gives Americans immense purchasing power, cheap imported goods, affordable travel. Losing that status means a relative decline in purchasing power. And fourth, a loss of geopolitical power. Financial dominance enables sanctions and diplomatic leverage. Without it, American foreign policy becomes much more constrained. This doesn't mean an immediate collapse. The British pound lost its reserve status over 30 years. It was a gradual process. Britain remained wealthy, but it was no longer the center of global finance. America would likely face a similar transition. So what are the key indicators that this transition is accelerating? First, watch BRICS expansion. If major economies like Indonesia, Nigeria, or Turkey join, that's a significant shift. Second, watch Saudi oil sales. If Saudi Arabia announces majority yuan-based oil sales to Asia, the petrodollar is effectively over. Third, watch the dollar's share of global reserves. It's at 58% now, down from 70% in 2000. If it drops below 50%, that's a huge psychological tipping point. Fourth, watch gold prices. If China announces gold backing for the yuan, gold will spike. That announcement could come anytime between now and 2027. And fifth, watch yuan usage in global trade. If it crosses 10% of all transactions, it becomes a legitimate alternative reserve currency. China announced their goal in 2015, replace the dollar by 2030. We laughed. They're not laughing anymore. 5 pillars, all operational, all advancing. A new payment system, when internationalization, gold accumulation, breaking the petrodollar, and global infrastructure. This is happening right now, whether we acknowledge it or not. The question isn't if the dollar will lose its reserve status. The question is how fast and whether America adapts or declines. What do you think? Is China going to succeed? Will the dollar remain dominant? Or are we watching the end of American financial hegemony in real time? Drop your thoughts in the comments, especially if you're from one of the countries I mentioned. Your perspective matters. If this analysis helped you understand what's happening, hit subscribe and share this with anyone who needs to see it. Because the next 5 years will determine the financial structure of the next 50. And most people have no idea it's even happening.